Good afternoon, everyone. A very warm welcome to all of you. Hello, everyone. It's great to have you here. We'd like to begin the session, please. On behalf of the Impact Investors Council and the Asha Impact Trust, a very warm welcome to all of you. My name is Divya, and I am a part of the team ISC. We really appreciate your time for having come here and being a part of the first ever launch of the complete blended finance report of all the transactions that have taken place in India over the last 13 years. It's also the formal launch of the India Blended Finance website, the one-stop shop of everything that you wanted to know about this space. As you can see on the schedule here, we have a lot of interesting sessions lined up, all of which promise to delve deep into the space of blended finance. We begin with Mr. Ramraj Pai sharing his opening thoughts. This would be followed by a very interesting fireside chat with Mr. Vikram Gandhi and Mr. S. Raman discussing the future of social finance in India. This is to be followed with the formal launch of the report and the website. Thereafter, we have Ms. Aparna Dua, Director, Asha Impact Trust, sharing some of the key insights that we've seen emerge from the analysis. We also have two very interesting case studies lined up. This would be followed by a panel of experts sharing their experiences of all the work that has happened in this space ground up. So to kickstart this discussion, I'd like to request Ramraj to share his thoughts.
Welcome, ladies and gentlemen. It's a pleasure and privilege for me to be here. I'm Ramraj. I head up the India Impact Investors Council. As many of you would know, we are a not-for-profit industry body which has been set up to evangelize social impact investing in this country. It's indeed a pleasure for me to be here on behalf of Asha Impact and IIC on this very important event on taking stock of blended finance market in this country. As we all know, there is a huge need for developmental capital in this country, even more so post-COVID. Climate finance is going to further exacerbate the need for developmental capital, particularly in sectors which are emerging and that there is no past track record for commercial funding to come in. India, contrary to what has been believed, has a long history of blended finance. It is just that possibly this was never called blended finance to begin with. It could have been called viability gap funding. It could have been called subsidized guarantees. It could have been called in a variety of other terminologies. But this country has had a long history of blended finance. And I think the government, DFIs like SIDBI, NABARD, and many other organizations have in different forms been trying to support many, many emerging sectors. And I think they've done a fantastic job of what it is that has happened till date. But that said, I think the need for developmental capital is far larger. The need for funding in this sector is growing at such a fast pace that I think there is an urgent need for us to think about how is it that we can attract private sector capital, how is it that we can attract philanthropic capital, and how is it that we can bring all of these parties together to create a very active development funding market in this country. Right now, this market is small, this market lacks scale, and blended finance can obviously offer some solutions. What is important for us is really to evaluate how mixing up commercial capital with concessional funding, with concessional grants, with concessional guarantees, how is it that we can bring this together to create a much larger market? How is it that we can bring philanthropies, foundations, CSR, and private capital and government capital together in some fashion to create a truly large and scalable market for development financing in this country? This event today is part of our initiative in this direction. What we are trying to do in this event is really bring together a variety of stakeholders who are involved in this market. We are also trying to take stock of this entire blended finance space over the last 8 to 10 years. We are also trying to explore what further can be done to catalyze and further activate blended finance in this market. So on behalf of the IIC, on behalf of Asha Impact, with whom we've been partnering on this very important agenda, welcome to everyone. Thank you everyone for being here. And we do hope that this is going to be a very interesting and innovating discussion for everyone. Thank you, and over to you, Divya.
Thank you, Ramraj. As Ramraj said, there's immense potential for this space to evolve and for different forms of capital to come in. What we'd really like to understand is how can this happen to accelerate the impact that's happening on ground. And for this discussion, we have with us two very eminent voices from the industry. Mr. S. Raman, Chairman and Managing Director of SIDBI. Prior to joining SIDBI, Mr. Raman has been involved in various initiatives and has also held positions with the Comptroller and Auditor General of India and with SEBI. A very, very warm welcome to you, sir. Joining him is Mr. Vikram Gandhi, co-founder Asha Ventures and senior lecturer at the Harvard Business School. Over his vast experience in Indian and international markets, Mr. Gandhi has been engaged in various initiatives that champion the cause of social finance. Thank you once again, sir, for coming on this occasion.
Let me also just add my welcome to everyone as one of the co-founders of the Asha Impact Trust. Just by way of background, I'd set up Asha, the whole platform, about 7 years ago with one broad objective, which was how can we co-opt private capital into the development agenda. And the definition of private capital being that that capital needs to earn a commercial risk-adjusted return. So to do that, we've set up two kind of platforms. One is Asha Ventures, which is an impact investing arm, which is really not the topic of, or not the focus of this discussion, but it's an investing venture capital firm which has an impact lens, but also a very big high return lens. And then the second piece was setting up Asha Trust, where we've experimented with different forms of initiatives to, again, with a broader objective. But one of the key things, in our view anyway, which is why we partnered up with IIC, with the Impact Investors Council, was to focus on the whole area of blended finance into how can government spending, philanthropic spending, catalyze private capital into the development agenda. So therefore, for me to kind of get some of the thought leaders here and discuss and debate as to how we can really expand this area in India. I mean, as you'll see from the report that Aparna talks about later, you know, the whole blended finance kind of journey in India has been about $5.5 billion, which in the big scheme of things is really not that much. And so I think we should be making it more than 10 or 20 times that. And that should be, you know, like having a big, hairy, audacious goal should really be our goal going forward. So when we were thinking about, in terms of the launch of the report, as to who would be, you know, the perfect person to come to kind of discuss with us, you know, Mr. Raman came as our first, right on top of the list for us, and he was so kind enough to take the time to be here from Mumbai to be with us. Because SIDBI and under the chairman leadership has really been historically set up to promote small business and medium-sized business, has essentially been a huge catalyst. So maybe we just start with that, Mr. Raman, in terms of your experience of SIDBI's goal in the development agenda and being in the middle between government and between the private sector. Maybe we'll start there and then delve into some specific examples and then get your thoughts as to where we go from here.
So a very good afternoon to all of you, and thank you to Ramraj and Vikram for inviting me here. Certainly, you know, our paths cross at various points. So the fact that we have a body called the Investment Impact Council, I think is a great thing. So I learned that the hard way when I sort of came into SIDBI and saw a plethora of sort of work happening, some big, some small. And at the end of it, there was not a single document to show what was the impact that's been done or that's, sort of occurred on the ground. So, it's more anecdotal. I'm sure all of you in this room are probably more aware of different aspects of SIDBI, but the single biggest contribution that I am told by the likes of all of you is that, the whole incubation and sort of growth of the microfinance industry was something that SIDBI sort of held its hand and sort of made it grow. And I think that contribution is tremendous. I mean, there's just the fact that there's an alternative to so many people to get money, not from a money lender, but from something which is, was probably not regulated, later became regulated, but even when it was not regulated, it was a more sane level of interest rates, and the kind of tactics that were used to collect money were a little more humane. But it's really about, I think today, understanding that if there is 25 lakh crores of borrowing by MSMEs in this country, and of course, something like 30 to 40% of that would be borrowed by the medium sector, and the remaining would really be with the small. The micro is certainly a much smaller share, but nevertheless, the estimates of demand of credit is probably another 25 lakh crore within the next 3 years. Now, that's the kind of estimates. Of course, there would be multiple estimates that, come over the years. But we are really looking at the need for ramping up debt capital. And it's largely debt. There probably is some amount of equity also that's needed within that. So how do we really go about it? And that's, I think, where people like Vikram, you come in and, create one more dimension of how international money could probably flow into the country. And it's philanthropic, which is what is more visible right now, but, how do we move from just philanthropic money to maybe the commercial capital that can come in? And, as perceptions go, I mean, what is a commercial return is really based on what a US investor or a European investor is looking at. And in that sense, when I look at SIDBI's own performance, it's roughly today about 3.5 lakh crores of lending that SIDBI has got on its balance sheet. And I would say the entire 3.5 lakh crore is a blended finance. So we do get money, as you would know, from the RBI, which is a concessional finance. We pick up money from the market in all sorts of forms, from CDs to CPs to debentures and bonds. And between the two, we have a mix today of about 65% market borrowing, 35% concessional finance. And that is exactly what we put into the market. So today, if it were an NBFC or an MFI, which is looking at raising money, they can probably get money from SIDBI at somewhere between 8 to 11%, depending on the entity. And that would probably end up being the cheapest form of money that they could get. Again, when we lend directly to the MSMEs, we sort of made it a policy in the last 2 years that we should be the cheapest lender in the market. Now, obviously, there is a higher element of risk, but having said that, our own balance sheet is obviously very small as compared to what you would have in the larger banks of this country. And therefore, we've been really trying to think of how we should be able to step in and take that additional risk and thereby invite the larger amounts of domestic capital to come in. So what we did as just an experiment, Vikram, and this was in the last, I think, 6 to 9 months, where in order to grow smaller NBFCs, and some NBFCs could be as small as 25 crore AUM. Now, how do these guys try and get more capital? So we worked out a solution with one of the more vibrant entities, Vivriti Capital, and we're trying to do the same with Northern Arc, where we're looking at a risk sharing between the two of us. So we come in with, probably trying to give money to these people at say 13 to 14% as compared to, what otherwise they might get, or maybe it's a little lower. And we therefore come in with the bulk of the capital, and Vivriti comes in with the risk element of it, so that they do take the first loss if there were to be one. And therefore, we have managed to fund over 50 small MFIs and NBFCs, adding up to about 360 crores. Now, per ticket, it's not very large, but the very fact that they are getting access to more capital. And the aim is really that if we were to then go to the market and say that, SIDBI has come into, the unrated bond of XYZ NBFC, then would we be able to find that, an SBI or a ICICI could follow suit? So, there really has to be an ability to go ahead and take that risk. And therefore, we have done many things to sort of mitigate the risks. And one of the biggest thing is really an industry standard, or hopefully it'll become an industry standard, where we've simply taken the loans that are given by the NBFC to us as our receivable. So when we lend to any of these, smaller lenders, our security is the receivable of that particular lender. Now we have no line of sight of what that loan is, who has taken it, and what is the receivable. So we've just completed over the last 1 year a POC with Infosys and AWS, where we've worked out the fact that using the credit bureaus, we've got the data of these people sitting on a shared database, so you could call it a blockchain, and thereby we know exactly what's happening to that loan and what's happening to the repayment, because that data comes through the credit bureau. Now, I really see it as, an ability, if you sort of expand it and go forward, SIDBI has given loans to 10 NBFCs, SBI also gives loans to those 10 NBFCs. Now, one thing is very clear, that the NBFC cannot give the same loan list to SIDBI and to SBI. So, there's immediate dedupe that will happen. So, there is the need for all of us as lenders to be able to get some better, sort of hold on what's happening. So, this is another form where we've tried to sort of mitigate the risk in the entire lending, such that we find it easier to lend to such people.
So I think using technology, which is the example you just gave of AWS and Infosys helping, is again, we think is a huge opportunity. So we should talk a little bit about how we leverage technology platforms to encourage more blended finance. If you look at like you said, everything that you do is essentially blended finance in a way, but there's the kind of what I would say lower rate lending, which is maybe the bread and butter historically. But going forward, for example, the one you gave with Northern Arc or Vivriti, could you take us through just a little more specifics as to how that works, so that I think that may be a great example of things that we could be doing going forward, where you kind of cut up the risk and return between different entities to co-opt in more commercial capital?
Yeah, so I mean, it's a simple sharing. So we say that, our return is say 11 or 12%, and the other partner says that they would probably come in with say a 5% FLDG. So the first 5% is a risk that they would take. And given the fact that at the end of that, tenor of that particular paper, assuming that it's given out at 16%. Now, again, these are numbers. Finally, the lending happens to the end borrower at something between 25 and 26 or 30%. But again, it's much lower than what the unregulated money market is. So, these are figures that, if I were to say in front of a parliamentary committee, they'll sort of hound me and say that how can you even lend at 16%? But, this is the reality of India. So, we are all trying, people sitting in this room, we're trying to sort of bring rates down from, upwards of 60 and 100% to, 30%. So, that's so basically whatever upside there is for that particular bond, the that would sort of go to the partner who's taking the larger risk. Now, this is really an experiment where having, sort of tested these waters, tomorrow we should, as SIDBI, be able to take the higher risk and return.
Correct, yeah.
So, that's really where then we would be creating the impact in the market so that we end up taking the higher risk and then bring a host of other lenders in as the Class A unit holder.
Yeah, exactly. I mean, I would think that over time, SIDBI be the one that takes, because that's the kind of capital role. What about, you'll have also done something recently in the whole EV lending space or created a pool of capital. Could you take us through that particular example?
Sure. So I think, the entire sort of green asset space is something that we've plunged into, and we've sort of, quickly set up the required resources to take us through that. So it's really about, once again, providing interest rates at the lowest level. So we've actually working virtually at cost. So if, my weighted average cost of capital is, say, 6% across the bank, then, I'm, standing there at 6.5% saying, anybody who wants to buy an EV, come and buy it. So, that is, in a very simplistic way, what we are attempting to do, saying that, how do we convert the entire market? Now, the market is all of 60 or 70 million vehicles. Now, converting them from petrol to EV is going to take its own sweet time. But, every new vehicle that is sold should be an EV vehicle. And that's where we are partnering both with the NBFCs, because honestly, the NBFCs are that much quicker off the blocks. So, giving them money at cheaper rates so that they can also then, sort of on-lend that. And so we're looking at whether we should have a cap or not. But what we've created is a partial risk-sharing facility where we will end up, taking the first loss. And therefore, there is a first loss based, predicated upon which the loan is given. And so that is one easy way of doing it. And the other one is really to bring in the aggregators. So what we found is that a lot of, again, using technology, a lot of people have sort of created these platforms where the model is that they would own the vehicle and then lease it out to the various people. So, and the target market is really the, sort of large number of fleet operators, the Swiggy and the Zomato. And so, either it comes in through the, through the Swiggy and Zomato, or it even could be at an individual level. So, both these have the effect and the reach across the country. So what we're really saying is that we would come in with our capital at, the sort of lowest of low that we could possibly do, and then allow for that market to grow. And then also cover the entire loan under what is known as the CGT-MSC, so the Credit Guarantee Trust that we run, which I think, again, is an amazing experiment over the last 20 years, which, let me just spend a moment on it. So, it's sort of, over the first 17 years, we saw probably something like 50,000 crores of loans getting covered under the CGT-MSC. And over the last 5 to 6 years, that has grown all the way up to 4.5 lakh crores. So, there is a huge appetite, which I think is just reflection of the appetite for debt in this country. And therefore, what we've done is, of course, we've put in 500 crores in the latest infusion of 8,500 crores that government has brought in. So it is, in a sense, creating a much larger corpus so that we end up supporting another 2 lakh crore loans. And that is something which I think has a sizable impact. So we've also managed to bring down the guarantee rates, which were somewhere in the range of 1.3 to 2.5%, which has now come down to 0.37 to 1.3%. So it's sort of, multiple times reduced, and therefore making it much more lucrative and easier for the banking system to use this. So essentially this, it's like a sovereign guarantee, but I would say a much more nuanced form of a sovereign guarantee, which does not allow for 100% guarantee, but you restrict it to about 75%. And a lot of other operational aspects have been made easier, including revamping of the entire platform. So, this is another way that the entire EV space, which we're really looking at, I would say, 1 million vehicles in this year and, probably some growth in the next year. So if we can look at funding 1 million vehicles this year through this entire sort of, low interest rate, the credit guarantee scheme, which is first a risk-sharing facility. So luckily the credit guarantee scheme also allows for you to sort of take off the risk-sharing bit or the first loss guarantee, and then you can take the remaining part under the credit guarantee scheme. So I think all put together should make the entire space that much more attractive for lenders to sort of come in.
So if you step back, maybe move away from your SIDBI role and just think about like the broader development agenda of India, which obviously SIDBI is an important part. But I mean, if you think about the fact that India has to create 10 million jobs, that's the most important thing, and that actually is more than the next 10 countries combined in the world. To make those jobs happen, there's got to be tons of investment. I mean, obviously, a lot of other things need to happen, but huge amounts of investment, of which a large chunk of it is debt, like you said, right? That till now, there's been a demand, especially for the middle size of MSMEs of 25 lakh crores, but it's a very glaring statistic. You said that the demand actually, till now, has been that, and the next 3 years will be the same amount that has been historically. So from that perspective, what are the impediments as to why that hasn't happened or hasn't happened as fast? And what would you suggest we need to do both from the private sector standpoint and maybe from the policy standpoint to kind of accelerate that process?
No, it's great. I think, you've really sort of captured the need that this country has got. And I think from a policy standpoint, making it easier for lenders to just put money out is, I think, primary. So all of us, and therefore, luckily we've sort of led that entire effort, is to be able to collect digital data and process it and make the entire sort of credit assessment process that much easier. We've already talked about the fact that there is now a guarantee scheme which will back, so let me say that for every loan up to 10 lakhs, you have a guarantee fee of 0.37%, which is really not going to be counted by any lender anymore. So it's just sort of, as if it's for free. So, for that segment, which is typically the missing middle segment, you are talking about making it that much easier for the lending to happen. So the bank statement becomes critical in this. The bank statement has been sort of analyzed ad nauseum by every fintech in the country, and every fintech in the country has gone and sort of created this, good working relationship with one of the lenders in the country. So I think I would say collectively for all the lenders, we are at a situation where loans can be given out within an hour. So we're talking about, anything, say, let's talk less than 1 crore. Now in that less than 1 crore, we have probably the 5 lakhs and below, where you may not have GST data, but persons who take loans for 5 lakhs and above would probably end up having GST information. And that is really, I think, a big sort of game changer. So we've managed to, along with CIBIL and OPL is the online public sector loans, so we've created a score called the Fit Rank, which actually triangulates the data of the GST, the bank, and the income tax return. And even if the income tax return is for some reason not available, just the fact that the GST and the bank statement put together is tremendous information. And when you sort of put it on top of the repayment score, which is there as a commercial score, it's called the CMR score in CIBIL language. So, these 3 data points allows for a bank to take that critical decision of a go, no go. And I think that is something which can transform. So we have, the top 10 banks all working very closely with CIBIL and OPL as I speak. SIDBI's already rolled it out. We've got up to 1 crore for customers of SIDBI and for new customers, an online process where there is absolutely no human intervention. So it's based entirely on this data and the scores. So, the scores have been created, sort of very rigorously. They've been regressed on a lot of information that has been lying with OPL over the last 3 years that they've acquired on that platform. So, there has been a lot of scientific sort of, attempts to improve the scores and the ranks and, use this public data. So I would really say that from a very granular operational point of view, we are at a point of time where loans, especially for GST entities, will end up becoming much, much easier. And I think that's really something which will end up taking us a long way ahead.
No, that's great. That's, again, using technology to kind of make it happen, and transparency, and also building out the infrastructure, which I think there's been a lot of investment. One other quick point, and then I'd like to open it up. So if you all have questions, please kind of keep them in mind. On the climate side, so we've got two challenges. One is job creation, and the other is decarbonization. So on the decarbonization, we touched briefly upon the EV space, but again, zooming out of just EVs, because that's a very small component of decarbonization, how do you envision blended finance structures helping channel more capital to kind of in the whole energy transition agenda for India?
No, in fact, I'd like to invite all of you to join a fund that we are now creating. So given the fund of funds experience that we've had, where we've put out, we've committed 9,000 crores out of the 10,000 crores that government has given to SIDBI, and of which I think half has been disbursed. So we are now creating a green fund of funds where we are putting in 500 crores, and I invite all of you to sort of come in with whatever capital that you would like to bring in. So I think, it's time for us to really have a large fund of funds, which will again work through the same principles of giving money to a host of other AIFs. We are saying that we will allow those AIFs to put in money to a variety of companies, but for the money given to them, they would give 2x of that for green assets. So, companies which are essentially doing sustainability. So I think the time has really come for us to, expand this in a significant way. There's solar rooftop, there is EV, there is energy efficiency. The energy efficiency is another area which we're working very closely with the Ministry of Power and the BEE to create another large program, which would probably end up being upwards of $1 billion. And to be able to just bring in energy efficient methods, which of course, all of which will end up, reducing the carbon emission. So, it really requires people like us to sort of enter into the space in a large way. And I think we've done a lot of spade work. A lot of these programs will end up rolling out as we go forward, whether it's the World Bank, KfW, ADB, everybody is sort of involved in this. So it's great to see, wonderful partners in this. But just sort of, from the, large macro picture, one is also talking about the fact that, the returns. Now, this is something which is always sort of struck me that, how is it that commercial capital is coming into India and still getting returns of 10 to 12%? And you're talking about people who are small businesses. I mean, you wouldn't even think of such returns. So we've done a host of interventions across the country. I can talk about, what I have sort of seen in the last 2 years and what's probably ongoing in the last 4 or 5 years. The kind of return on capital that is generated by small businesses is probably upwards of 50%. Yeah. And therefore, I really believe that we are all sitting at a point where return of anywhere between 10 to 20% is something assured if we put our money into those small businesses. So, this is really the larger understanding that I've got. It might be, a hall 3 times the size with 1,000 women sitting there. All MFI clients in, sort of something which was 2 hours away from Bhubaneswar. And you'll be shocked that in that room, there were 5 women which had graduated into creating private limited companies. Now, obviously, it's happening because the returns are large. And there is a hunger for more capital. So we have run this program. It goes under the name Prayas, but it basically brings our money in at a very, very low rate. And then we work with either an MFI or a BC, where we get the credit to be delivered at rates somewhere below 18%, as compared to the typical microfinance, 25 to 30%. And therefore, we are now looking at giving these people money which the microfinance could not give. So this is really between the 1 to 5 lakh range. Now, this is a program that can scale up hugely. So, we've in 1 year done 1,000 crores. There's 80,000 beneficiaries that we've managed to reach just in the last year. And I'm saying it probably can scale up another 5 to 6 times in the current year itself if we just manage to get more and more partners into this program. So, there is an amazing ability to provide returns. It's about us identifying those companies, hand-holding them, and that's the difficult part, because we do not have the resources to be able to handhold each small business. So we are also setting up something at a district level, which again is with partners. So every district will have a center which should be able to do both things, provide the connect for people to apply for a loan, as well as to be able to provide for that sort of mentoring and hand-holding of small businesses. So the scope is immense.
No, absolutely, and I think, that essentially is also a form of blended finance where, you are ultimately making things investable. For commercial capital to just come in and look at 1 lakh loans is kind of next to impossible. But I think because of technology and you're making it investable, you can bring in, but I guess again, the question really is, can we do it at scale? And the other is, like, from the other side, what would be the regulatory issues in terms of disclosure, metrics, especially on the decarbonization side, and that as soon as you put more regulation and more, or at least some regulation and some requirements of disclosure, that you actually, the demand for capital to kind of go into that area also accelerates. Well, with that, let me open it up for some questions. We have about another 10 minutes or so, which we can have with Mr. Raman here. So any questions from the audience? Aditi, you have a question?
So, we are really keen. So I'll give you another example. So sort of Google came to us and said, listen, there is 100 crores subsidized rates. So we put that through and gave loans to women at 5%. And 100 crores disappeared in about 90 days. So, it's really about, once again, getting the right product design. It's difficult to think of giving loans in this country at, 5%. Now, somewhere you need to do that in bits and pieces and then hope that, more and more capital will come in, which does not demand the kind of returns. So, even from our own balance sheet, there's only a limited amount that we could put out at 0% and then invite a larger amount of capital to come in and blend it with that. So, it's a very difficult question to address. So we are trying to work out a livelihood bond which would address the concern largely for women, and working with the Ministry of Rural Development on that to be able to see whether we can scale up something in the region of 500 crores, which would then be available at those kind of rates. So, these are really experiments, but again, I go back to what Vikram is saying, that we probably need to configure ourselves better so that somebody sitting outside looks at it and says, listen, I want to plug into that. So, are we being able to sort of design it, package it properly, and then present it? So another thought which we've been toying with along with NABARD is the social stock exchange. Now, is that something that is ready for us to place projects on such that people sitting anywhere in the world could at least have a full view and visibility of those projects. And I mean, there's numerous projects that we are already doing. One of them along with FCDO, which I thought was an absolutely brilliant, it was called a challenge fund, and it brought out some of the best small businesses that I've seen. And one of them, I will market them right here, is Looms of Ladakh, which I thought was an incredible product, which frankly, they told me that the GI tag for Pashmina actually belongs to Ladakh and not to Kashmir. So, but they've got an incredible product, which frankly, I do not know who's helping them through this journey. We've given whatever small grant that we did give them, but these are typically the kind of businesses that if we were to list them out on a social stock exchange, I'm sure we'll end up getting a lot of people interested in and wanting to.
Now that you bring up the social stock exchange, can we talk a little bit about that? Because I've also been involved a little bit in the SEBI discussions about that. Where does that stand, and how do you see that evolving? Because that's something which, again, the ability to have a kind of mechanism where investors can come in a blended form is potentially there, but it has different formats in different parts of the world. So it'd be great to see what your perspective is on this.
So, we have this committee with, NABARD and SIDBI and the stock exchanges on that. And what we're really trying to do is to understand what sort of formats would be needed to be able to sort of present projects in a standardized manner. So it's, you just need to sort of have something which looks reasonably similar, so that if I were to scan through and, I mean, actually you'll end up doing searches. Like you were to choose a hotel, you'll end up, choosing projects. So you need to be able to standardize it and put it in the right sort of, terminology with the right metrics all placed within it. So that's really the work that is currently going on, and we are using some of our own projects to be able to try and work on that. So it is not moving at a very fast pace, but more than happy if anyone in this room or outside this room is wanting to join and help us in that process. But I think there could probably be again, I'm not saying that it will attract commercial capital from outside, but it might just attract a lot of philanthropic and SDG-oriented capital.
Yeah, and if it does attract that, then those entities can then, in turn, attract potentially commercial capital of some sort. But I think one of the key issues, which, again, I think we need to work on, and we'll, in the blended finance report, we'll also talk about this, which is that apart from the credit guarantees, et cetera, which are more straightforward, the more innovative structures, which we think can actually have massive amounts of impact, are also highly complicated, like a stock exchange or these DIBs and SIBs and other things. And so actually creating streamlined processes, and the reason is that, when you compare different investments and different structures, when you're looking at financial, okay, it's ROE, it's growth rate, it's IRR, developing the impact metrics which cut across those various development initiatives becomes that much more complicated. And you started off this discussion by saying that SIDBI does all this, it kind of feels like impact, it's anecdotal, but we don't have any comprehensive metrics to actually evaluate how the impact is being done, correct? So, Aparna, sorry.
I'm sure you can take either of these.
Yeah, we don't need.
Yeah, that's fine.
I guess two quick questions, so to you and to Vikram. One is, of course, on impact metrics. I mean, given the kind of volumes of capital that's been mobilized towards the missing middle, so to speak. I mean, if we see SIDBI's role as a lender to some of the NBFCs that you mentioned, like say a Vivriti and a Northern Arc, are there any reporting requirements from an impact perspective? Because that's something we've heard over the course of last year as we were interviewing many providers of catalytic capital, that creates a bit of a dissonance between concessional as well as commercial capital, whereas the rigor of impact measurement may be missing when there's commercial capital involved. So just wanted your thoughts on that. I mean, as SIDBI, do you see that as going forward? You talked about blockchain and stuff. Do you see impact measurement becoming a key ask when you start lending? So maybe I'll start with that and another question in case someone else has.
Yeah, sure. So, it is vital to do a proper impact assessment. I think, if we've started late, but I mean, we're on track. I think we've actually got an impact investment done for a host of our activities, and the aim is to try and bring it out. It may not come alongside the financial statements, but it will be another report at a SIDBI level. Having said that, it's more important to have an impact assessment at the individual project level. And that's really when, a lot of, features start emerging, which you yourself might not have seen when you were doing the study. The Sundarbans is another great example of how SIDBI walked in after the hurricane that hit Sundarbans maybe 4 or 5 years ago. And today there are over 1,000 women who are actively running small businesses because you went in and gave them the kind of skill, capacity building, etc. And of course, a lot of grants that were given at that point of time. So I would really say that we failed to do an impact study of that. Probably we are doing it now. But if that kind of thing were to go out, I'm sure it would end up attracting a lot of interested impact capital. So it goes without saying that this whole business of impact measurement should probably end up getting a much higher sort of degree of importance. Probably a council like, Impact Investment Council should put out standards if it's not already doing that.
I think there are actually some of the work being done globally could come here. So, for example, the IFRS, which is the Global Accounting Standards Board, has teamed up with what's called the Sustainability Accounting Standards Board, SASB, to really merge where they have been historically just talking about financial metrics, but actually putting in impact metrics, not just some blanket impact metrics, but going by industry and sub-industry and identifying 4 or 5 key metrics, and for small business as well, like what should be the disclosure. We can go on, but we had a couple of questions in the back there, and then we need to kind of move on. Yes, back there, yes.
So my question is, like with innovative blended finance structures such as SIBs or DIBs, is there a possibility that these non-profits, rather than just being financial sinks, can become assets that can be securitized and would also contribute to the development agenda as part of the discussion that we have? Any comments on that from both of you?
So, we end up working with a lot of not-for-profit entities. And we sort of call them as our partners on the ground. And in fact, they know much more than we do when we go to the ground. So, they're an essential part of our development agenda. So, how do we formalize them? I'm not too sure whether they are interested in getting formalized, because they probably do not wish to become anything else, because then you come under some regulation or the other. So, I think it's really important to understand what is their own need, what is their own identified growth path, because a lot of them are doing excellent work at that ground level and probably just want to continue doing that. They do not wish to probably get into the lending space. So I really don't know, it's probably a very, very micro level decision of each entity.
I would just add, I would add to that we, from a blended finance and development sector, the role that NGOs play is absolutely, absolutely critical. What has, I think, been an impediment right now is that each one of these structures is very, very complicated, And so our goal right now, I think Asha Impact and others here in this room are kind of working towards that. How do we streamline this so that actual capital can flow at scale, and every time you want to create one structure, it doesn't take 1.5 years, and the whole NGO is stuck in it, and et cetera. So that's clearly a big kind of a to-do, if you will, going forward, but it's definitely a very important one, which is high on our agenda. Maybe one last question, and then we will, yeah. So which are the most high return, juiciest, small scale? She wants to invest the portfolio there.
Stop picking at its best.
Stop picking.
I honestly would say that the agro-processing is very high on the agenda. From whatever little I have myself seen, the fact that you can bring in money at the right point of time causes the, I'm not saying it necessarily is the farmer, but the guy who is maybe the next on the value chain will end up reaping a tremendous return because he is not getting into a distress sale. So I think the emergence of FPOs is one very good feature that's happened. If the FPO actually can be this sort of cooperative or represent a bunch of farmers, then you have the farming community actually looking at a tremendous return on investment. So, we are looking at warehousing, which will store the produce. We're looking at processing units, however small they might be, which creates the next level of intermediary, which can then be sold over a period of time to the next processing unit. So I think there's a tremendous value, which today, obviously, someone in the system, the intermediaries are obviously taking that value. So it's just a matter of transferring the value from an intermediary to probably the person who has put in more of the hard work.
So there you go. You got your, you better do some research on which agri-industry to make. I think Mr. Raman has really laid out very well for us where we are in the blended finance area, where SIDBI has played obviously a critical role, but I think what's also, at least for me, comes out of this conversation that in a T20 game, we are in the first half an hour of the game here, and we have another 3-4 hours to go before we can actually get to the point where the needle is truly being moved and the full potential of blended finance is being reaped. Our goal actually with this report was to actually kickstart the agenda where you have some facts and data to use to kind of going forward. And critically, obviously, SIDBI has played a very, very important role in that. Your leadership has been instrumental in that. So again, on behalf of all of us, we'd really like to thank you for taking the time to be here with us, Mr. Raman. So thank you very much.
Thank you, Vikram. Thank you all.
We now, with your blessings, like to inaugurate the report as well as the indiablendedfinance.org website, which is a one-stop shop for everything you want to know about blended finance. So thank you, Mr. Raman. Thank you, Vikram.
I just must add that I got a sort of preview to the report, and I must congratulate you on an excellent report. It actually opened up my mind to so many things which I probably didn't even think of. So great report. Thank you.
Thank you. In fact, just on that, I must build one small comment, which I think Ramraj talked on. So we had a little briefing, and Mr. Raman went through the report. And he said, oh, I didn't realize that SIDBI does blended finance, which is all that they do, which is the catalytic blended finance. So thank you very much for all your support, Mr. Raman. Thank you.
Thank you, Mr. Raman, Mr. Gandhi. Such a fascinating discussion for all of us. I mean, I've personally taken away so much from there. And like Aparna mentioned, this is also the formal launch of the Blended Finance website, the one-stop shop where everything that you ever wanted to know about this space is there. So on the website will be hosted different forms of content. There will be events mentioned, there will be seminars, there will be research publications, all which tie into the complete blended finance journey that you're on, whether you're an expert practitioner or you're just somebody looking to get started with this space. There's something which we would like to see for everybody. So this is what the website is about. And also hosted here is the deal tracker. Mr. Gandhi, Mr. Raman spoke about the importance of data and evidence-backed research for us to understand how really this space is evolving. So this deal tracker contains those deals which so many of you have contributed to. This is currently a repository of over 13 years of transactions which have been documented, wherein you get to understand the different forms of stakeholders, the kind of capital that got leveraged, and the kind of impact that was seen across sectors. So this entity continues to be a live one on the website. We will continue to update it with transactions as we go ahead, and thank you so much for helping us with this endeavor. So a lot, as we spoke about the report and so much that we've had to learn from it, what we'd really like to now get into is understanding some of the key insights that have emerged from the analysis. For that, I'd like to invite Ms. Aparna Dua, Director, Asha Impact Trust, to share some of these key findings with us.
Thank you, Divya, and it's an honor to be presenting the findings from the report, which we've been working on for the last over a year now, along with IIC. So I'm not going to spend much time talking about what blended finance is, since we've already discussed that. But I think it's critical to just take a pause and say, why is it that we looked at releasing this report and database today? Now, blended finance, as Ramraj also said earlier, is not per se not a new topic per se, but has been ongoing for many, many years, and institutes like SIDBI have been at the helm of this. But it's now that countries are waking up to the dire need that we need to mobilize more commercial capital to meet and finance SDGs, and which is why it becomes critical to look at such structures. What is it that we can really do to mobilize more commercial capital, philanthropic capital, ODA? What the government is doing alone is not going to be enough to help us meet these targets. In India, this looks at about 2.6 trillion, as per some estimates, and this has only gone up to the tune of about 2 more trillion in light of the pandemic. So we've really got to act now, and which is why, as Asha Trust as well as IIC, we felt now is the opportune time to put out a database that really captures what's been happening in the market since 2010, as well as a landscape report talking about who the key actors are, where the capital has been flowing, etc. So as we started out this journey, we realized that there are multiple definitions that have been adopted globally for blended finance. Now, all of these converge on a few critical factors of concessionality, leverage, as well as additionality of impact. Very quickly, what these factors are, we've put together this framework adopting from these, global definitions of blended finance to help us objectively classify what is and is not blended finance. So the first is impact. The rigor we realized varies from transaction to transaction, as we also heard Mr. Raman say. It's a very important aspect for us. However, the smaller transactions seem to have much more rigorous impact evaluation vis-a-vis some of the larger structures. The second is leverage, so whether or not we're co-opting commercial capital. The third was looking at factors for concessionality. Now, these could be in terms of actually returns on a risk-adjusted basis, or catalytic capital playing the role of market making or providing more favorable terms to commercial capital. The fourth is looking for signs of positive financial returns, which could range from concessional to market rate returns. And fifth was the time frame, so whether the blending is happening within a given transaction or a particular time frame. Blending is trending, as we can see. So last year, the market hit the $1 billion mark, but this is based on a ground-up analysis, so we feel that this could clearly be 15 to 20% higher. Cumulatively, the Indian blended finance market stands at about 5.5 billion, the CAGR of 18.8%. This has obviously been growing steadily over time, and as per our projections, we're projecting it to go to about 2.5 billion by 2027. These are all obviously very conservative estimates, and hopefully after today's conversation, we can all catalyze much more capital going into this space. On average, India has seen about 14 blended finance transactions, and this, when you compare it to global numbers, is a fraction of that, where we've seen about 50 to 60 transactions annually. And 5.6 billion actually represents only 3.5% of the global market cumulatively, which stands at $160 billion over the last decade. Of this, 80% has been commercial capital and 20% has been concessional in nature. Moving on, as we see the mix of commercial capital, while globally public investors such as MDBs and DFIs have constituted about 2/3 of the market. In India, we see banks and NBFCs have played a much larger role, as Mr. Raman also alluded to in the fireside chat. Some of the key challenges that have emerged for this class of investors is the pipeline, the actual scale and structure of the actual, the scale for capital absorption, as well as the structure of the underlying transaction. Impact assessment, as well as we just discussed, there seems to be a little bit of a dissonance between the providers of commercial capital as well as concessional capital, because concessional capital is looking at much higher standards for impact evaluation, which oftentimes commercial capital lacks the capacity to provide. So this is one area where we feel commercial capital could work on building its capacity, and which would also lead to much better trust and sort of structuring of these transactions. Moving to catalytic capital providers, here DFIs have been the most prominent investor category, followed by international foundations. Some of the key insights that have emerged, firstly, is the tremendous learning that's being driven by some of these international foundations as well as DFIs. This could be in the form of knowledge sharing, support on collaboratives, market building, due to the flexible capital that these organizations bring to the table. The second is an important one around sunset clauses. So when we spoke to providers of concessional capital, this is something that they felt should be embedded into the contracts right at the start, so that they're not providing concessionality on a never-ending basis. And as a sector mature, or as the risk perception goes down, we would like to see the leverage on catalytic capital to be much higher. The third, we feel that there is a significant scope for family offices and CSR to come into such transactions as well. Now, globally, we see much larger participation by family offices, but this has been a very small percentage in India, and we feel therein lies a huge opportunity for this as well. But of course, this requires a lot more awareness building, a lot more data to be presented, a lot more case studies as well. And the fourth point, and I think a lot of you will smile when I say this, is the legal and regulatory aspects around how blending can actually happen. Okay. Moving on to looking at the instruments in the Indian market. We've seen guarantees to be the most widely used instrument over here, and globally, of course, concessional debt, as Vikram and Mr. Raman spoke about as well, is the preferred instrument, but in India, it's guarantees. And I think the reason for that is it allows people to maximize their balance sheets as well as address specific risks. We'll see some examples of this. Dheeraj from Rabo Foundation, will be talking about their role in the agri space, how they've catalyzed the market. USAID, USDFC, have been providing partial credit guarantees as well across sectors such as agri, healthcare, forestry. And this has really helped build momentum in the market as well. TAs and grants, which are at about 25% of the market, have also been a huge game changer when it comes to seeding innovation. Here, I think a good example is what water.org did to actually provide TA grants to help microfinance institutions actually design products specifically to scale up credit going into sanitation as well as potable drinking water. The other end of the spectrum is results-based financing instruments. Now, while these are actually just a small percentage of the market, they've created an outsized impact in terms of driving our attention to outcomes, as well as creating evidence of what really works on the ground and what doesn't. When we look at instrument usage by sectors, I think this is again something that got alluded to in the fireside chat. We've seen the more mature sectors gravitate towards the simpler, scalable structures, such as concessional debt as well. And here, I think where TAs and guarantees have really played a role is to actually create evidence again and proof of concepts for what aspects or what subsectors can actually credit flow into. So we've seen, as the sector matures, or again, as the perception of risk goes down, there's a gravitation towards moving away from more bespoke structures, which are guarantee-backed, to the large-scale, more simpler to understand credit, concessional credit structures. So looking at the market by vehicles, now globally funds have been the preferred blending vehicle, but in India we are seeing about 45% of the market actually is into facilities. And the reason really that we unearthed during our conversations is that facilities offer a very high degree of customization. So at the very top level, you can create the economies of scale by pooling in capital from different sets of investors. And at the investee level, you can actually customize the diligence, the structure, and hence this flexibility that is provided is the reason why a lot of investors actually prefer investing via facilities in India. Here, a good example is the Samridh facility, which has mobilized close to $350 million towards healthcare just in the last 2 to 3 years. Moving on, looking at which sectors have commanded bulk of the capital. So on a volume basis, we've seen this is a fairly even distribution across sectors. However, from a value perspective, financial services and energy have gotten about 65% of the market. This mirrors global trends as well, and I think the reason here really is the financial services sector is obviously more mature, more amenable to such credit enhancement instruments, as well as it's well regulated and well funded. The energy sector as well, as one spoke about, is getting a lot of thrust, not just within the country, but globally as well. And hence we've seen a lot of capital flow into both financial services and energy. Going forward, our survey revealed that this will continue to be the case, but we'll also see agriculture, healthcare, and livelihoods to see more traction. So leverage is a very critical measure of success of a blended finance transaction. In India, we've seen the leverage stand at about 5x, which means $1 or 1 rupee of capital that has flown in from a concessional pocket has actually mobilized 5 times that in terms of commercial capital. As per IFC, when one compares this to similar countries with the same income level as India, the leverage was close to 5.4x. So, while I think we still have a lot more to do, India is not so far behind. Guarantees, we feel, though the leverage here is only 3x, we feel that this could be much higher in practice, because as per our calculations, we've assumed that the entire guarantee facility has been earmarked as catalytic capital, but this could in actuality be just a fraction. So that means the leverage could actually be much higher. Right, so what are some of the critical issues? These came up in the fireside chat as well. So when we surveyed close to about 50-55 organizations for our report, I think there were 4 key challenges that really stood out. The first is a clear lack of awareness that these structures are actually around, who the key actors are, where the capital is flowing, what the structures are. The second is a clear record of impact and financial returns. So, in the case of concessional capital, they wanted to see what is the additionality of impact. In the case of commercial capital, they wanted to actually see a track record of financial returns being delivered in these projects. The third is the cost and time of structuring, which also got touched upon in the fireside chat, and regulatory and legal issues. And I think, as I was talking to some of you before the event as well, I think this is something, compliance, everyone is trying to grapple with. So I think the key to actually having a more flourishing blended finance market in India would be to actually have very clear, legal as well as regulatory aspects. So lastly, what lies ahead? Where are we headed? I think there are a couple of critical things that we need to work on as an industry, work closely with the government as well as with the capital providers. The first is setting up institutional frameworks, setting as well as legal and regulatory issues that need to be ironed out so that more capital can come in. The second is, how do we really build scale in this whole system? How do we design for that? So I think looking at templatized models that can operate at the scale that we really want to, I think is going to be critical for us as an industry. And third is really creating, awareness and trust between the different actors that provide the capital when we look at the blended finance market in India, and that this report and the database is really the first step towards doing that by actually creating, data that can show that yes, financial returns are possible. This is how structures are working. With that, I'm going to hand it back to Divya, and the report obviously has a lot more detail, a lot more examples. So I really hope that all of you will pick it up over the weekend, and would love feedback and would love for your continued support as we continue to grow out the database in India as well. Thank you so much.
Varna, so as we've seen, there's been so much for us to learn about from the report findings, from the transactions that have taken place. We thought it would be good for us to have a little more deep dive into understanding what's really happened on ground when these transactions got executed. So we'll be learning 2 case studies about 2 different forms of capital. And for that, we have 2 experts with us, Mr. Dheeraj Mutreja from the Rabo Foundation and Mr. Amit Garg from COIS. So without much ado, I'll just like to hand it over to them. Dheeraj, if you could please come over.
First of all, congratulations to IIC and Asha Impact team for coming out with this blended finance report, which was sorely needed in the sector. And so, hi everyone. Today I will be giving a brief introduction to the India COVID Response Program for Agricultural Transactions, which we launched in September 2021. Before I move on to the structure, I would like to give you a brief or rather history of the blended finance transactions that we as Rabo Foundation have done in India. So back in 2013-14, we realized as an organization that we have to move from a grant-making structure to an impact financier. So at organization level as well for India level, we realized that being an impact financier is a much more effective way to ensure the benefits reach our target group of smallholder farmers. In 13-14, FPOs were being promoted by state and central government, but financing to them was not easily available. So we provided our credit guarantee to a NBFC to enable first loan to an FPO in the country. And once after that, we did provide several guarantees to FPOs. And once that was successful, after 3-4 years, we started giving portfolio guarantees to banks, NBFCs to provide financing to these FPOs. Similar to FPOs, we realized that in 16-17 that technology can actually make an improvement in livelihood of smallholder farmers. So we supported an agtech startup by again partnering with an NBFC, providing it with a credit guarantee so that it can provide working capital facility to a startup. Once we, our experience with one agtech startup was successful, we did another 4-5 individual transactions, and after that, we have run several financing programs for agtech startups. We had launched a Rabo Caspian agtech financing program in 2019, it ended last year, and it was pretty successful. We are also planning of launching something similar again. We also launched a first of its kind post-harvest commodity finance guarantee. It was a 2-stage guarantee product to help FPOs access commodity warehouse finance, which they would otherwise not been able to. This was done with 3 leading banks and an NBFC. In 2018, we partnered with USA to launch Sustainable Landscape Guarantee Program. This was a 15 million loan portfolio program fronted by Ananya and Samanati for a 10-year duration. This is currently still running and is basically used to provide financing to FPOs, businesses, cooperatives operating in the sustainable landscape sector, which includes agroforestry and climate smart agriculture practices. What we learned from our experience of doing this transaction was that the local financial institution need to be ready for green financing, or you can say needs to understand what sustainable financing is, or need to understand what ag-tech startups are, how to finance them, or what climate tech startups are. It's very important that that financial institution have this capability. Second, there should also be a bankable demand for the product. If there are not many borrowers for these NBFCs banks, they will not be interested. They might be interested at conceptual level, but if there are not enough borrowers, they will not be interested to take it forward. Another thing, TA needs to be a part of the financing program. If you just run a financing program and hope that the borrowers will behave normally and become bankable over the course of the time, it does not happen. We have run several TAs to help FPOs, capacity building of FPOs, and help them become more bankable. Another, the most important thing is that partnering with local financial institution is the best way forward, and giving facility in the local currency is ideal, because India, we have talked about regulations. Getting foreign funds into India is quite difficult, and it has become difficult over years. So we did a lot of blended finance transactions, and we were making an impact on our target group, which was smallholder farmers. But we realized that as compared to the base of smallholder farmers in India, our impact would be considered a drop in ocean. So we realized collaboration and partnership is the key going forward. We invested in the ecosystem that we have. We partnered with institutions, like-minded institutions, on a bilateral, multilateral basis. And for this COVID response program, we actually brought together institutions across geographies and across sectors. So we had, Rabo, IKEA, Shell Foundation backed by FCDO from the Europe, and DFC from America, and the 3 NBFCs based out of India. And these are, or you can divide them into public, private, and development sector. Now, coming to the structure of the program, here, Rabo Foundation, IKEA Foundation, and Shell Foundation backed by FCDO provided a one-time grant to USDFC to enable it to provide a 50% pari passu guarantee to the 3 NBFCs to build a loan portfolio of $55 million over a tenure of 8 years. The funds, would be used to finance 4 asset classes. First would be FPO with a gender angle. Basically, all FPOs that are being financed, members of the FPO should have 50% women, female farmer members. Second is, ag-tech startups, which are working closely with smallholder farmers. Third is food loss solution companies, which can include warehousing, supply, logistic companies. And finally, companies which are providing renewable energy solutions, clean tech solutions in the agri sector, like solar-powered cold storage, solar irrigation pumps. And what we also did with this, along with this financing facility that we enabled, we also are running our technical assistance program to provide capacity building, to fund capacity building initiatives at the lender level and the borrower level. So the lenders might not fully have understanding of the sustainable, or they want to develop their sustainable policy, or they want to have some software or employ some resources to help them acquire more asset in these 4 asset classes. So this technical assistance program can help them. Or if a borrower needs, say, FPO needs some capacity building, so this TA can be used there. We have run this program since September 20. It's been 1.5 years. Considering the complexity of the program, we had employed Sambodhi Research as our MEL partner for the impact assessment. They have just come out with a draft report, and there are many learnings. I am just highlighting the key learnings. We realized that the lenders were able to onboard borrowers which were new to them. So with this guarantee, so they would have bought financing to customers which they would not have otherwise financed without this guarantee. We also observed that some of the borrowers were able to raise additional capital from other sources once they were part of this, once they got financing under this guarantee program. And finally, we also saw some farmers were, using more climate-smart agriculture practices. This is, the year one, and there is a lot more to go. And as we, get more learnings from this program, we hope to improve this program and, reach the potential impact and scale.
Thank you for having me here. I think we are a little short of time, Aparna, right? So I'm going to rush through a bunch of this. My name is Amit. I work for something called Cois Invest. For those of you who don't know, we run two businesses. One is our fund management business. We run 5 funds. 3 of them are actually here. In India, we've got FCDO, I think, Proparco, and SIDBI LIC as some of the LPs. The other part of our business is our blended finance advisory practice. Globally, I think we've mobilized about $100 million. One of these blended finance instruments is what I'm going to talk about today. This is a construction industry specific rabbit hole, which some of you who know me from longer know that I went down during when I was working with Godrej. And what we were trying to do here is effectively look at ethical construction sector practices for workers. Let me just take you through the context, and then you'll understand what I'm talking about. So the pyramid that you see on your right is essentially what a construction pyramid looks like. It is essentially a debt mountain. Everybody in the value chain that you see here takes debt. All of the risk is actually at the bottom of the pyramid, and reward largely is at the top. Hence, you will see that the cost of capital to developers is close to our sovereign rates, but the cost of capital to construction contractors, which is the second largest layer here, is anywhere between about 36% to about 120% annualized. This problem of working capital debt at the bottom of the pyramid is what we were trying to solve for. And the reason we were trying to solve for it is we thought that this is a means to incentivize the construction contractor to actually pay workers' wages on time. That was the theory that we were trying to explore. This was the consortium that we put together. Haq Darshak, some of you know, does social security provision. LaborNet works with construction workers and construction contractors. They basically mobilized all the construction workers and contractors for this. Gromore is the non-banking financial company that we actually capitalized for this transaction to happen. Satwa led our PMO, and Cois is who we are. We actually got a grant from the Norwegian Development Aid Organization to do this. This is a very small facility in the context of what we are talking about. This is only about $250,000, and really the idea was to explore something that has never been explored before. So please don't compare us to the work that Rabo Foundation did, which is typically in the millions. Really what we are trying to solve for here, as you can see, is the fact that working capital doesn't exist at the bottom of the pyramid. This applies to a lot of sectors, but we were looking at specifically construction here. We are looking at largely $5,000 loans with a working capital cycle of about 60 days. This money is largely used to hire workers, buy raw material, things of that nature. And because of the pyramid structure that I told you, typically the construction worker is the last one to get paid. So let's say the developer gets paid first, the second layer, third layer, fourth layer. The construction worker is the last one who gets paid here. That is the problem that we are trying to solve. This is the structure that we made. It is actually not as complicated as we've made it look, but thankfully, we got Michael and Susan Dell Foundation and the Acumen Fund to put down about a 40% first loss guarantee, which they, thankfully, because of COVID, actually increased to 70%. So we are very thankful for that to have happened, which allowed Gromore to actually lend to individuals who've never historically received a formal loan. Remember, these are construction contractors who themselves are migrant workers who have graduated to becoming contractors. There's varying estimates, there's about 70 million construction workers. You can assume that about 10% of them are contractors. This is construction, as you know, is the second largest job creator in our country after agriculture. So it's a huge problem. Working capital remains a huge problem. What we actually found here, there's lots of learnings. Also, COVID happened, so there's a whole layer of learnings that happened on top of that. But simply put, we got about 120 people access to loans who had, as I said, never received loans before. Some of these loans were paid back. We have a 92% recovery rate as of now, which is, which I will say is the only data set that you will find on construction micro contractors, because nobody's actually lent to them before. So 92% recovery rate. To do this lending, we actually capitalized grow more. We raised money at about 4% from European family offices, typically small family offices. After hedging, this 4% rate of return was actually brought to India at about 8%. NBFC's own NIMs and all of that took it to about 18%. So effectively, this loan came to construction contractors at about 18% annualized, again, which is a historic first, has never happened. Yeah. Obviously, it's impactful, it's great. We are very happy that it happened. Thank you so much. Thanks, Abrita.
I won't take much of your time. I'll leave you to listen to the panel that we have now. Ramraj, over to you.
You know, over the years, I have moderated a lot of these panels, but potentially this is one of the most high-powered panels that I have moderated, just in terms of the capital that all of the partners here bring to the table. I would say in the Indian development finance sector, I could maybe add another 2-3 names, and I think we would get maybe 75-80% of development capital that comes to the country. So this is genuinely a very, very high-powered panel, and it's indeed a pleasure for me to be moderating this panel and hearing views and thoughts from all of these stalwarts in the larger development finance sector. So what I'm going to do is I'm just going to begin by just requesting all the people on the panel for a quick introduction, and also maybe some initial thoughts on their sort of broader experiences in blended finance, in the development finance, in the sustainable finance space. After that, I'm going to focus on broadly 2 or 3 key areas as far as this market is concerned. One is really the whole issue of supply. Are we getting enough supply? What are some of the challenges to supply? And second is, we're going to really talk to some of the investors in terms of demand. Is there really, from a larger sector, is this something which is a big mandate for investors? And I think the third issue that I want to really talk about is, how do we engage with government to really bring together capital at a very different size, scale, and dimension compared to what we see in the blended finance? So that's the broad format of what this panel discussion is all about. We're going to try and keep this to about 45-50 minutes, so that, and then we can obviously join for, high tea and continue the conversation. So with those kind of sort of initial comments, I'd maybe just go around the panel for some quick introduction, some quick initial thoughts on blended finance, what has been their experience, and then some specific questions for each of the people based on the format that I spoke. Maybe Manav, we can begin with you. Yeah, please.
Yeah. Good afternoon. My name is Manav Bansal. I head British International Investments Office in India. We have about $2.5 billion odd invested in India, and we invest between $600 to $800 million every year in India. Most of it is a combination of what we would call as blended finance, and we can come into it later. I would just want to start by speaking something that I spoke to Ramraj earlier today. I think what IISc is doing, especially in the last 2 or 3 years, is fantastic. It's upped the game and brought the entire construct of impact investing to the forefront. And I think very well done to you, Ramraj, and your team, and good luck continuing that.
Thank you.
Thank you.
Hi, so I'm Gaurav. I head the capital team at of the British government here. And I echo what Manav has said to Ramraj, to IIC, the wider team, Ranjana and others, and Asha Impact for coming up with the study and inviting me to the panel. I think it's a very timely topic, and I think collectively it's for us to be able to size the ambition across what does impact mean, because we are midway to the 2030 agenda of the SDGs. How are we achieving that? Because everybody knows that we're somewhat off track. But how does blended finance, how does blended capital mobilize large amounts of money so that we can we get back on track? And what does it take to get back on track to deliver the 2030 agenda? I think that's quite big from the development standpoint, and also something which all of us in the room, I know, worry about in that sense. We are quite innovative in the UK government. We have our own portfolio. We have worked across the different aspects of what was presented earlier, different sort of segments of guarantees, concessional capital, TA market building role, also something on the risk return, results-based sort of financing through the work that we've done here in India, as well as centrally of what the FCDO does in the UK as well. And we can talk more about it as the conversation goes on. Thanks.
So I am Dr. R.K. Singh. I head the Green Finance vertical in SIDBI, as also I handle international cooperation. We are carrying one theme which is very simple, that financing the green will not happen unless we green the financing. So we are working on this model, and we are trying to blend not only the finance and development, the supply and demand, as also certain uncharted, unknown territories we are trying to venture. And we reach places, I was telling outside only that even if uninvited, if it is a green topic, we will be there somewhere sitting.
Hi everyone, I'm Apoor Shukla. I lead Innovative Development Finance for USAID. As you know, USAID is US government's premier development and humanitarian aid agency. In India, we work across healthcare, climate change, WASH, digital inclusion, women's economic empowerment, WASH, and innovative finance, blended finance is core to almost everything we do, where we want to use our $120 million odd budget every year to be catalytic in bringing more private and philanthropic capital into the system. And really excited to be here and look forward to the discussion.
Thanks, Apoor. Thanks, Ramraj. I'm also indeed honored to be on this high-powered panel today. My name is Prachi Wendless. I am from the Michael and Susan Dell Foundation. We are a private foundation of the Dell family. We've been in India for 16 years. We invest in 3 areas: education, financial inclusion, and jobs and livelihoods. And in each one of those, we have just one focus, which is improving the outcomes in that sector. So in education, we define it as improving learning outcomes, college entrance rates, and then graduation rates. In jobs and livelihoods, it's getting more youth into the jobs, into progressive career pathways. And in financial inclusion, it's enabling credit to nano entrepreneurs. So, so in a way, blended finance and innovative financing is something which, as the definition in the sector are changing, our own counting of it is changing. We invest close to $30 million in India every year. We've cumulatively invested more than $250 million across grants, equity investments, debts, and guarantees. And because we put impact at the core of it, we've always changed whatever is the right instrument for it, whether it's a candidate for a grant or it's candidate for concessional debt or for a guarantee. And last, when we were looking at how much money have we put out in the form of blended finance, it was upwards of $45 million. But then we keep changing the definition. Okay, this also counts as innovative finance, and that is also blended finance, and therefore not getting stuck in what really we've put out in the form of blended finance, but we've given our focus on impact and how core we are to improving that. We have, I would say now, experimented, piloted, or scaled all kinds of instruments, whether it's impact bonds, social impact bond, concessional debt, equity, which is actually a very large part of our portfolio, as well as guarantees. So as we progress, we can talk about our experiences with all of them.
Thank you, Prachi. So I just still remember meeting Dr. Singh, I think a couple of months back, and I said, sir, we are doing all this blended finance. And he said, you know, we are not much involved in blended finance and all. And then I explained to him that, you know, this is essentially a sort of, you know, a new word for, you know, leveraging concessional capital to really attract, you know, regular commercial funding. And, you know, we were just then, he was just commenting that I think pretty much a lot of what CDB does is really in some form or the other blended finance. So let me just begin by sort of, you know, start off with both Apurv and Prachi, both of who have been through their organizations and individually engaged very intimately with the blended finance market in various ways. So I think you guys have been in part investors, in part not structurers in your formal way, but very, you know, intensively engaged in structuring. You've also been very actively engaged with the execution organization. So maybe I just want to begin with you in terms of just your initial thoughts on, you know, how this market has been developing, what have been some of your big learnings, and what do you see as, more importantly, the challenges and opportunities. So I think we'd like you to speak about just, you know, what have been your learnings, challenges, and opportunities, and then we want to go on to some of the investors and just get a sense from them as to how they are seeing it.
Yeah, I'll take a crack at that. So in terms of what we've done over the last decade or so in blended finance, there have been, I'd say, 2 or 3 broad kinds of interventions. One, and this is a decade-long, a few decade-old product for us. It's the credit guarantee mechanism, where we work with local private financial institutions in countries that we are present in to help them enter new sectors, new segments, new types of borrowers. So currently in India, we have about partnerships with 14 financial institutions, mobilizing over $500 million in credit, and largely going towards small enterprises, micro enterprises, and enterprises that are doing innovative things in the impact space in the sectors that I spoke about. So that's one big piece. Second one, which we've recently started experimenting with, and now I think are going to bet a lot more on going forward, are these pooled grant facilities, where exactly as Prachi was alluding to, how can you use your investments and our grants in this case more flexibly, innovatively, depending on the need of the enterprise as well as the need of the investors who are coming partnering with us. So Samrid is an example of that, where we've invested grants, but those grants are being used for social success notes in case there's a need for increasing focus on outcomes, in case there's need for decreasing rate of borrowing for enterprises. We've used partial credit guarantees, first loss guarantees in case of high risk perception from lenders. We've used technical assistance to build capacity, etc. So I think that's one big area which we've learned a lot from, and seeing the success of that facility where we've been able to mobilize 10x on our investment, we'll do a lot more on. And lastly, we've also been part of a lot of these pay for success instruments, development impact bonds, and other simple results-based financing. So that's overall been the context that we've operated in the last few years. In terms of, I think, benefits and opportunities for us as a donor, I think the biggest 2 pieces have been, one, leverage on our own investments, where $1 of our investment on an average with guarantees is mobilizing funding of 20-30x. On Samrid and similar facilities, we've seen anywhere from 8 to 12x. So I think that's one big piece. And secondly, we've been seeing blended finance play that role of a bridge for even investors to come and sustainably lend or sustainably invest in these sectors, which is what we ultimately want to do. But I mean, I know we'll all get into challenges, but maybe Prachi can talk about what they've also seen.
So I'll also go in a similar fashion that Apurv did on and just jump directly to what we've learned. Just taking examples from some of the instruments that we've seen close now. So the impact bonds we've seen close now. So 2 big benefits which came out of the the quality education impact bond, which has closed, and 2 cohorts of the skilling impact bond, which is about to close. Some early results from Revive, which was a returnable grant facility. And of course, some of the work that Amit also alluded to, which was a COVID response debt facility that we had put out. So I would say 2 things which we saw come out almost everywhere is that because of this impact orientation coming in and getting attached to the financing itself, some standardization of metrics which are actually meaningful for the end customer got accepted and standardized. Otherwise, between funders and then, that's what your service providers are actually doing on the ground, there is usually no concurrence on that. So in the skilling impact bond, for example, we added to, it's for skilling and eventual placements of youth, we added retention in jobs as the additional parameter. Otherwise, it's usually how many did you certify and then how many entered the jobs, at what salaries, but we entered retention into it. And as a result of it, there is a big level of concurrence between at least the set of founders, the 4 service providers which are there, and a whole bunch of investors, NSDC on, these being the important metrics. Similarly, in the quality education impact bond, we had that on the learning outcomes of kids. So that is one thing which I see as a big benefit in so much divergence to start bringing in these metrics which are actually meaningful for children, for youth, for entrepreneurs on the ground. The second thing which we've seen as a result of it is that a lot of capacity gets built in the service providers who are actually delivering on them. So again, I'll take the example of skilling impact bond. They themselves looking at their processes which were not even tracking whether, those who are certified, they're getting placed, how long they're staying. If they don't stay in those jobs, then why are they not staying in those jobs? Some very meaningful things came out for them to go back and change their interventions on the ground to be using that dollar more effectively as a result of so much of, I would say almost scrutiny happening on the results that they're reporting. And those 2 things I've seen consistently across all the blended finance that we have engaged in. The bigger opportunities, of course, like Apurv said, Amit was alluding to earlier, there's a big leverage. We would have funded many of these on our own, but with the pooling of funds, with the debt facility, that the leverage that you can ask for, we have seen 2.5x to 15x leverage in the kind of funds that we have put out. We've also seen, not to the extent that we would want to, but we've also seen that, because of the pooling of the funds which would normally not participate in such instruments because of the, just structuring it, just putting it together, managing it on your own, the amount of money that you're putting out, funds that would have not participated in such instruments also come out. So it brings in some fresh capital into the mix as well. It brings the leverage, it brings in the fresh capital, it elevates that standardized set of metrics for others. But we've not seen it to the extent that we would like to. So I think for us, the next phase and the challenges that we see is to see more repeatability of these instruments so that we are not designing every time a new instrument for the same old sector, for problems which are not getting solved at scale. So we would like to see some repeatability of these instruments. We would like to see, therefore, more funds and larger facilities getting created of it. And the regulatory challenge which Aparna alluded to actually is one big risk which is not within the, within the scope of the funders and the service providers to solve for, but that's a big challenge today on the structuring of these instruments. I would say more critical than many of the other things that we're talking about.
Thanks, Prachi. I think both the important points that you and Apurv have raised. I'll just move on to some of the, if I may say, hardcore investors on this panel, and just wanted to sort of flip that question and really understand from a larger perspective the appetite for blended finance, especially at scale. Is this something that yourselves are from SIDBI, FCDO, BII, see as sort of an important market from 2 perspectives? One is really from your commercial capital perspective. That's from your commercial capital hat. Is it possible for us to create sort of larger transactions? Because eventually, sirs, the whole idea is somewhere to be able to take this to government and showcase that we've done 100 million or 300 million, 400 million. Can this now be scaled at a different level? And they will only listen or look at it only if it has reached a certain size and scale. So from a commercial capital perspective, one is if there is enough demand. Second is, from your own portfolios, is there any availability of concessional capital? Because one of the challenges, and Dr. Singh, we have also discussed this, is the availability of concessional or grant capital. Because if you want to do even a 10x, 20x leverage, you need that 1x of grant capital. So maybe some thoughts from all of you people in terms of just from your own portfolio perspective, how do you see blended finance? And what do you think is the potential for us to kind of do something of a certain size and scale which, builds the building blocks of a larger market? Maybe three of you can comment.
So we'll start with one theme only,
Yeah.
which is EV.
Yeah.
Like we are working, I don't know whether the chairman would have mentioned.
Yeah.
So it's a big market. Mission 30 at the rate 30 means by 2030, 30% vehicles to be turned this way. It means 30 crore vehicles are registered, and 9 crore vehicle as on date should become transit to this mode. And we are working out with World Bank and ADB a project to address this segment. And we are still working in lakhs and talking about bringing the transition. So to do that, basically the segment which we cater, the green investment is treated as last. Because MSMEs, and particularly the MS, which is micro and small, they would struggle more on their existence and whatever level of growth they can maintain rather than go for these sort of green investments. So one is to induce them to look at this side. And second is, there are, like in the EV segment itself, there are emerging players, startups, new companies, aggregators who are coming out with innovative approaches to handle this, but they don't get financing because then we look at it traditionally. So what we have done is we met almost 650 stakeholders across the country, had a very focused discussion with them. And based on that, we have evolved an instrument, which is one is channelizing the funds. Second is the risk sharing facility, because this risk mitigant tool or a credit enhancer is very essential. I call it, it stands like Mahuna. Why don't you lend? So this is what SEDBI has been doing for the last 7-8 years, implementing a World Bank program on partial risk sharing facility, where we evolved a ESCO market in the country on the energy efficiency side. Today we have 12 lenders who are availing that PRSF facility. And touch wood, what we have developed is a model where it's not any loan and every loan gets covered in risk sharing. We do technical evaluation of that proposal initially and then cover it. Until now, all accounts have been standard, which we have done in this portfolio. So that is same thing we are bringing this side. It's a big market. We are talking to other multilaterals, including ADB, and look at this market as a big one. Second important thing, if you see the Indian, say, carbon neutrality resolve, we are working on the solar rooftop side. And that is another segment which is very important and crucial for MSMEs per se, where they struggle with margins and all. But to convince them to go solar rooftop was the thing which we had to really work. Second was to convince the appraising officer to look at these aspects differently was another challenge. So we have trained almost 50% or more of SEDBI core financing guys attuned to these emerging areas. So first was training them to be aligned. And then second was we started working with the demand side. Like for example, we have launched sustainability perception index. which we run in cluster and gauge the preparedness and perception and orientation of MSMEs to go green. And we tell them that, see, green is last, but green will last. That is what we tell them. This is what you have to really look at it. So when SETB brought this up, instead of going to the multilateral partners, we ourselves internally, we convinced our management to give me a pool of fund where we launched this mission 1,000 crore solar rooftop in 1,000 MSMEs in 1,000 days. And so we did it almost in 4 or 5 months. 650 crore we have invested in MSMEs. Now we have made it 2.5x. So what we are trying to create is, first I will do it and then go to multilateral partners to invest. Yeah. And that is the theory. SETB has picked up 4 or 5 missions at national level, and we are working on it. First do it, then I think fund is not a problem. Partners are also there. And we can get going. And
how is the response from the banking sector, so overall?
So yes, that is what when we started the energy efficiency PRSA facility, we went to, because this was to be implemented through partners, as a risk sharing anchor, we were not allowed to lend by World Bank initially. So nobody was ready to venture into this. Then we convinced World Bank, allow us to first lend. Because our lending arm is an arm's length from us who manage the risk sharing facility. And so we created a portfolio, then went to the lenders. So today we have 12 lending partners who are actively availing, and we are withdrawing. In the sense, that is what is a market maker role.
Sure.
Same, the solar side, when SETB has come into this, I can tell at this forum, we offer the lowest rate in the country. The idea was to correct the market right way. The second is we have induced cluster level investment to happen. So for example, if 25 enterprises go for solar rooftop, the rate goes down further.
Nice.
So we waive off our, like for SETB customers across, we have waived off our processing and upfront fee, we don't charge. Now this is what is the market maker role. I find traction happening on this front.
Yeah.
Great. So I think, the opportunities for commercial and the role for concessionality, I think were the 2 points. And I think we can just go again by sectors in terms of how we've seen and appraised the opportunity. So for example, if it was microfinance as such, I think we've worked with, say, SIDBI to try and also provide that first loss capital in terms of trying to absorb that risk so that institutions of Government of India who are able to do it at scale are better able to do it at scale and at the sort of rates that the market sort of needs. And that could be using their expertise and working through that, where we provide our capital at the very back end with, say, SIDBI. We've also done, say, the first impact fund with SIDBI, where and with State Bank of India, we did the first low-income state small infra fund, the NEEF fund. And the purpose of us doing that was to try and focus our commercial capital into areas like the low-income states of India where capital was not going, so that we could show successes and demonstrate and attract more capital into them. And all our programs were designed to have a little bit of technical assistance so that we could, when we invest our commercial capital, we could make sure that the capacities of those companies and in some of the challenges that they had to navigate, that we were with the company to try and provide them that sort of support to be able to grow. Because we realize that demonstration works both ways. If you fail, then the market gets even more risk averse. But if you succeed, then of course it unlocks a lot more investment. And we've been able to have very different leverages. So if you look at how we've partnered with some institutions, we've been able to have an impact of 100 times of capital leverage and mobilized through not us, but them in many ways. And I think that's a great sort of number. But bottom line there is about being very clear upfront in terms of design attributes about what is it that you're trying to achieve on an impact scale on the commercial front, and where is it that government capital inherently, which is concessional in terms of terms, in terms of the risk appetite it's able to take, all of that, I think, sort of comes in. Now, we've also worked at scale with, say, the multilaterals. So, for example, at COP26 and, within India, the World Bank is one of the big lenders into climate finance projects. We realized that there was a ceiling that they could not do more, and therefore the UK government was able to unlock a 1 billion line for further financing by taking the risk on our balance sheet as the UK government. So that was announced at COP26, and that's something that we've done. And in terms of, I think, the balance of concessionality, like where are the opportunities? I think, we've also been, the UK is quite innovative in terms of the DIBs and SIBs and all of that. Yeah. And I think there, there's a clear role between different providers of capital and the risk return expectations they have. And then there are other pools like the Social Venture Capital Fund under AIF where it's clearer. Yeah. But there are a lot of other areas where it's not so clear about where the different providers of capital go. So one has to sort of pick very carefully where one goes. And if there was an opportunity for us to do more in terms of trying to blend different approaches there with the supporting sort of regulations and all, yeah, I think that market could really scale. Yeah.
Yeah, so Ramraj, I'll answer the question that you asked and I'll tell you what's wrong with that answer, yeah, if you permit. So we have 3 or 4 tiers of capital. We have our typical commercial capital. Then we have what we call as catalyst capital, which essentially is for making riskier investments. Then we have what we call as kinetic capital, which sits highest in terms of risk, where we do not expect to return that we will get the entire capital back to us. Then we also have a 4th capital, which is the grant capital. So in some ways, the very definition of blended finance. What's wrong with my answer is, and what we have here is that it would seem that there's so much blended capital available. You had Raman here earlier talking about how much is available. I just told you 2.5 billion. Gaurav spoken about how much UK government's done. So then what's the issue? Yeah. Yeah. I mean, I think that's what you're trying to say. If you're going to go to the government and say, where is the issue? Yeah. I'll give some examples of those issues. We just spoke about 450, 100 crores of CGTMSE. Right. Yeah. It would seem that every small micro enterprise should be able to get that. Correct. It's fully guaranteed, right? But it doesn't. The reason it doesn't is that scheme has challenges. There's an 18% cap. Then, for NBFCs who have the reach, they will have to give the entire portfolio. They pick and choose. So the blended capital from people like us have to figure out those solutions. Right. Our searchlight has to keep moving as the daylight keeps coming and try and finding those areas where this will work. Right. Because otherwise, when you will hear people like us speak, it would seem that world's problems have all been solved, right? Yeah. There's so much blended free capital available. Yeah. But it's not.
Yeah, 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 yeah. No, so thanks. I think that's a very useful point, and maybe I'll just go back to you, Manav, and just maybe request you to wear your SVL hat of earlier times and just give an example of, say, the Sri Fund, okay, which is a fund which was set up through the NSIC, Ministry of MSME, 10,000 crores. I would assume commercial fund, I mean, that is also commercial. It would raise at least 3-4x through the daughter and, the other funds. So essentially, through that 10,000 crore fund, you are raising 40-50,000 crore of innovative SME type finance, a decent amount of which is going for development sectors. So when we kind of, and that's a fantastic model. Is there a space for us in this market now, whether it is through USAID, through FCDO, through SIDBI, is there a space for us to think about a larger institutional arrangement? Because it does 2-3 things. One is it provides a certain legitimacy. Larger PSU banks, others will be very happy to participate because, it kind of ticks off a lot of the regular compliance, regulation kind of boxes. The government has also been talking about individual sort of blended finance vehicles. So maybe I'd just go back to you and just, sort of get your thoughts and maybe anybody else as to how do we really create large but simple vehicles where we can get more of institutional capital to participate, whether it is international, whether it is domestic, whether it is high net worth. Everybody wants simplicity. Everybody wants boxes to be ticked off where they're not going to get into trouble. Okay, the market is now completely the opposite, which is bespoke, complex, small in size, however well-intentioned the efforts are. Yeah. So maybe that would be my next question.
That's a perfectly put question. And that is exactly how we had designed the SRI fund.
Right.
So you could say SRI fund in many ways was a second generation or the third generation attempt of creating a fund of fund at scale.
Right.
I would say SIDBI was a first generation one. They've done a seminal job. Then came in the entire effort of FCDO, who put together UKIDCF. They created those benchmarks, those understanding, and that allowed the SRI fund to take it from the work that they've done and put it at scale. Now, what did SRI fund do? What SRI fund said is that I know what I want. I'm Government of India. I need to put out money to SMEs in a transparent, predictable, standardized form. I'm not looking for the highest returns, but I am going to gather a whole lot of information. A whole lot of information, which then allows you to make estimates on what is working for which category of investors.
Right.
So for example, it will be able to tell you that job creation or the impact at cost will be so much for funds which are deploying on average 50 crores.
Right.
It will be able to tell you that if you aggregate and disaggregate the data, which is going to be commercially most attractive, and which is likely to be, if you were to just make an argument, impact-wise most attractive.
Right.
Now, what it will allow somebody like a Prachi to do is to say, okay, this is the Venn diagram intersection that I will work in. This will allow somebody like a Gaurav to decide this is where I want to work in. This will allow Government of India to figure out that when the money is put at scale in a standardized fashion, because now there is oranges to oranges, there are no two different contribution agreements. That's what they try to do.
Right.
I mean, I'm speaking from my previous job, but
Correct. So essentially, sir, from the SIDBI angle, what you are loosely trying to create is a CGT MSc equivalent. May not be a non-funded. Here, it's a funded structure for bankable projects in the SME space. So coming back to maybe Apur, Prachi, and others, let's say we have to make this sort of, if I may say, sort of suggestion to the government. Do you see that there is enough supply? Because eventually, if say somebody puts in 5,000 CR and you're talking of a leverage of say 5, 7, 8 times, you essentially need 50,000 crores worth of decent quality projects, maybe across sectors, across themes. So do you think that there is enough scale of high quality bankable projects that like we did in the Sri? Because that market was much more clearer. Do you think that there is enough scope for that kind of business, which is relatively easy? There can't be extreme complexity of, how it will get executed, what is the offering, how is it? So maybe just some thoughts from a supply side. Do you see that there is enough supply of different but simple sort of pools of capital which is needed, where we could go and give a similar idea potentially to the government, because they could just seed it. And then there could be other investors who could come on top, maybe at the same level, maybe one level senior. You can actually create an entire waterfall of different levels of seniority, depending on who wants to play where, with the underlying sort of base equity coming just like in this refund from the government. So maybe some thoughts from you guys on some, because you've actually looked very deeply at some of these spaces, and then we can go on to some of the other questions.
I think a couple of things there. On just supply of projects or supply of quality enterprises. Right?
Especially, Apur, sorry, I'm just butting in. Say in the healthcare, you guys have done a lot in the healthcare. So let's say we want to look at, say, a 5,000 or a 10,000 CR development healthcare opportunity. Do you think that we will be able to have something which is of that size? It cannot be 100 or 225 crore projects. It has to be of some commoditized, non-bespoke sort of standardized scale. So that's really what I'm looking for.
Right, no, absolutely. And I think you'll need to look at different sectors differently, and you'll need like different levels of interventions on building that supply side as well, right? So I think healthcare is one that you spoke about, where our experience has been that the sector is sort of in a transition phase where that scale is not quite there in terms of, looking at 1,000 crore, 500 crore plus type of investment in single entity or that size of projects, except if you look at, tier 1, tier 2 hospitals or healthcare delivery facilities. But there's a lot of scope in that smaller ticket segment, say, 20 crore to about 80 to 100 crore. So I think how do you move those projects to that, big size? And I think that's where a lot of, interventions around technical assistance, enterprise capacity building comes in. And not only enterprise capacity building, I think building enabling environment, working with government on policies, working with, investors on getting them a better understanding of the space, etc., which is something we've done through Samrid as well. We've done TA tailored to the enterprise need to help them scale and actually attract that bank capital for big ticket size projects where we started with a small grant, but eventually were able to transition them to a much larger loan. So that's health. If you look at, renewable energy, for example, you'll find a lot of projects there which are fundable with some relatively smaller or bespoke level of technical assistance around, project development, project preparation. And then you have a sector like, say, WASH or, Dheeraj talked about agroforestry, sustainable landscapes, where you need a lot of deep, technical assistance interventions and policy interventions to, get even an NBFC debt to these players. So I think we need to have a bespoke set of technical assistance interventions to move the market from bespoke to actually, commoditized, and different sectors will require different things.
Yeah, any other thoughts from others? Because, really what we are looking for is simple, easy to...
I'll give an example.
Yeah, please.
And I'll ask Gaurav to give
yeah,
an example.
Please.
They're just creating what is called as a platform for taking Indian innovations out,
Right.
wherein UK government has decided to put in money. But it's such a modular structure where government of India is putting in money, UK government is putting in money, and others can just keep coming in, and they are coming. Or you want to just talk about that because that's a very
sure.
That exactly answers what Ramraj.
This is the one which is with the MEA, right? Is that the same one? Yeah.
Yes, and I think if people want to know the details, Neha, my colleague, is sitting in the audience, and she will be happy to provide details. But essentially, it's just that. It's about, and I think Manav has touched on this, where it is about the government looks at it as a public-private partnership as a form of blending as well.
Yeah.
Where there's a role for governments to come in and unlock and seed some of those anchor institutions to be able to then take it up to scale by other investors, ideally in the same vehicle, but also in subsequent vehicles.
Right.
And this platform with MEA is one example, but it builds on things that we've done with the State Bank of India through some of the funds that we've had in the platform that Manav was talking about, as well as through NIIF, where we did sort of set up the first fund of funds element in the Green Growth Equity Fund, which has taken it to scale.
Right.
And I think if you really go back to the question that you asked about what is the role for government to do here, they had in the last budget come up with several thematic funds that they have created an allocation for in that sense. But the challenge has been in terms of trying to find the right agency to be able to deploy them, and then for that agency to deploy that in a way where commercial capital can come in. And I think that's one of the areas where we feel that we've joined up and partnered with several of those agencies of Government of India to be able to try and create those structures which we will put in a bit of that money, and to get to 5,000, 10,000 crore, they will be able to sort of mobilize money from the private sector and international markets in a way. In some of them, there is an option of blending as well, and that blending happens through a multilateral involvement, but it has to be done at design, especially if government is trying to create and seed those assets. And I think for a problem of the scale where we are trying to address of a scale of India, I think those numbers, even 1,000 crores are not enough. It has to be much, much bigger. And I think then the question comes in about which are the agencies or institutions that can then take it to scale. And I would just say that the infrastructure pipeline in India, the national infrastructure pipeline, is nearly 2 trillion. So there's a huge opportunity in terms of pipeline, but somebody needs to vet it, find out the right impact, create those sub-segments from there, spotlight where that opportunity is in the Venn diagram that Manav was talking about, where others can come in. I think that's a real opportunity then.
So just to add, we are working on 2 emerging segments, solid waste management and compressed biogas. Huge potential out there. But if you have to really trigger this market, It's a tough call because see, in MSME domain itself, there would be 1,000 clusters which are energy inefficient clusters.
Yeah.
Lot need to be done out there. And I think we have mapped these clusters broadly. SIDBI is working on a program which is called Project GRIT. We have evolved a program, which is, we call it Green Inclusivity, where we work with micro and artisanal clusters and try to revive them back to the level they were and then scale up. So for example, we are working in Moradabad, reviving the brass cluster, converting them from coal-fired furnaces to gas-fired furnaces. This is something like, and then we have brought in ESCOs with whom we had earlier worked, deployed 4 ESCO company, given them competition, work with these, transit them, 100 of them to at least gas-fired. And if you find market out here, then I will fund you.
Yeah.
So this is how we are trying to create, and SIDBI would be working in next 2 years, at least 50 clusters. We are already in 7 clusters in first few months. In the last FI we have ventured. The idea is bring these players who can really see the market and then make them evolve by providing them capital from behind. So this is what the model will work. And the whole green story will be written from the bottom up only. So,
so do you think like there's a need for a dedicated sort of a vehicle? Because the CDB as an organization has multifaceted sort of responsibilities. Regular SME finance is one of them. We are talking here of a little different dimension. Is there, like we have the Solar Finance Corporation, which has done yeoman work in sort of building large institutional solar capacities in India. I mean, this is not some of the questions we have discussed possibly, but is there a need for us to think about like a dedicated vehicle which will sort of actually almost sort of seed support, build this out? Is there a need for us as a country to think about something which is, let me not use the word green bank, but essentially what we are trying to do is build markets for standardized, like say what you said about coal to gas fired, is a cross-cutting theme across industries, across various SME sectors. You could think about EV, like your movement to EV financing is again a cross-cutting theme. Do you think there is a space for us to think on something like that at a broader level? I mean, I'm saying that blended finance will be one of the elements, but is that something that you think we should be thinking about?
In fact, we are envisioning SIDBI to evolve as green bank. But, first, we wanted to set the pitch right. So we are working on 4 or 5 themes. And we will see whether the portfolio shifts this side. Like, say, last 2 years, we have enhanced our green portfolio 16 times. So we have just working on it still.
Got it.
But the vision is, you are right, there has to be a focus vehicle. And that is why we created this vertical which we are taking care of.
Got it.
Day in, day out, only looking at green.
Got it.
And to evolve that. The way we did for microfinance or for the startup.
Correct. Prachi, some thoughts from you, because you've done a lot of work in the whole inclusion space, but now with this whole climate issue, inclusion and climate adaptation, these are all becoming sort of cross-cutting themes. Do you see sort of this as a major sort of issue from the perspective of availability of large-scale projects which could get supported in a variety of instruments?
Yeah, so that's an important question, Ramraj, and it often comes up in all of our discussions, right? That if the capital was to become available, will we have the supply or not? So I'll just share examples from what we've seen in the 3 sectors in which we work. Every time we've tried to launch one facility, somehow this magic number of somewhere between 25 to 30 emerges as the number of organizations which make the first cut. I mean, when we did it for education, there were 30 shortlisted organizations. SIB, I think it was a similar number. And very recently, we were looking at the downstream portfolio of all these facilities which we had done under both the credit guarantee as well as the debt scheme, some of which we started during COVID. And we were saying when we start cutting the MSME portfolio and bringing it down to that nano sector, like the Kinaras and Arthans of the world, it again probably starts coming down to those 25, 30, NBFCs which are working really in the nano segment. Of course, there are many more. So, I mean, if you look at it from that perspective, yes, it's a very depressing picture of, very few, and I'm not talking from a climate perspective or healthcare, have lesser exposure there, but from our perspective, but then that's ours, right? It's a small foundation trying to do big things, putting a limited amount of money with too much cuteness around it, right? Ye bhi karna hai, wo bhi karna hai, and by the time people will sign up for it, it is just, it's not scalable because we are trying to solve for multiple objectives.
Correct.
But if you look at the startup ecosystem in India and the way we have evolved when billions of dollars started flowing up, supply was never the issue. Funds were never moving around saying we are not finding startups to invest in. Of course, there are corrections in the market which when overflow of capital happens will happen. But I think, today there is no indicator in the market or there's no signaling in the market that, if this done well, there is concessional capital, there is commercial capital, there will be more forms of such capital available. When that's coming from sources which are stable and longitudinal in nature, that will, the supply will automatically prep up because those signals will also come with the terms which will be well known in the market, like social stock exchange can be one such solid signal which can go out to the market. So yes, today the supply is limited, but it's being seen from the lenses of players who are not the scale players per se, right? They are that kinetic player that Manav is talking about or the catalytic players that we are talking about. But when mainstream capital from a social perspective, especially government, etc., starts coming in, I don't think in India supply will be a challenge. Today it is a challenge.
Great. Thanks, Prachi. I think, some useful point from your perspective. I'm just going to open up to the audience for questions. We have about 8-10 minutes, I think. One is a question, and then also we are looking for some answers. I think one is questions to the audience. The second is really around, we always talk about government should do more. We should engage with government. I think it'll be useful, maybe also from the audience. Lots of you are very actively engaged in blended finance. It's very easy to say this, but if you go and sit in front, and I've had that opportunity, if they come and ask you, okay, tell me the 2 things that you want or 3 things that you want to activate this blended finance market, what should those be? So that's a kind of a reverse question that I want to put to the audience. So broadly 2 themes for the next 10 minutes. One is questions to the panelists, and second is, if we just looking for crowdsourced answers, and these have to be simple. We can't make it something so exotic that no one can, really follow what it is. So 2 things. One is just, what could be those 2 things we should be suggesting in terms of what the government should be thinking about at a structural level, and the second is questions to the panel. So I'll just open it up now. Oh yeah, please go ahead, yeah.
Hi, my name is Rajat, I'm from GIZ. I've been working on the adaptation finance side, climate adaptation finance side for almost 3 years now. We've been able to create some platforms where institutions like NABARD and NBFCs and commercial banks could come together and provide direct support to, let's say, FPCs or pharma collectives. We saw there's a need on ground, institutional support on ground at the local level to ensure that there is further demand creation for finance and the ability or the capacity to utilize that finance in a productive way. Now, I'll come to the question that you have asked maybe after this, but my first question is that do you see that there is an institutional support that is needed, not on the finance side, but on the demand side, where the capacities are needed to be developed for scaling up? Because now when you need more farmers or more FPCs to come in, you have to also account for their capacity to plan for that financing and utilize it. And what sort of organization or agency do you think would be a good institutional support over here? And how do we localize it? Because most of these realities of resilience or climate are very local in nature. So do you think there is a need for such institution? And what could be such institution that can act both at a national level, maybe to bring together funds, and at a local level to ensure the local realities are also taken care of? And to answer that question, I think we'll
take that.
Yeah, please.
Anyone specific you want to kind of, is this
This is open to,
Yeah.
Okay, so Yes, so the short answer is yes, for sure. I think capacities need to be happen at the far end, because I think what we're also seeing, if you really take a big picture view, is that there may feel like there's an overflow of capital, but that's in very small pockets. In the vaster sort of wider parts of the economy, there is very little capital that's actually getting there. And I think this is one thing that I know that DPIIT also is very keen, because they're creating startup cells in every district in a way that can then work with the respective state governments, skilling councils, NGOs, a lot of the capacity building organizations, whether it's also farmer producer organizations, etc., to be able to then impart the kind of training that they will need to be able to receive the blended funds in their organizations, and not just receive those funds, but also have the right set of governance standards there, monitoring and measurement standards, because not all of the funds that will go in blended finance will be non-returnable. There will be returnable funds which maybe they're not yet used to, the rigor that goes in terms of managing somebody else's capital, where you have to return that capital also. And there's a big educational process that goes there, and also a big governance process that will go around with it, along with trying to get them to find the right risk-return capital that they need, because often they may get the capital they don't want, or that's not right for them. So there's a huge opportunity to do that. And I know that policymakers in India are thinking about it, but again, agencies like yourselves are also big players in terms of how to shift that mindset and look at it from that perspective. Yeah?
Anyone else in the audience? Yeah, I think, yeah.
Lot needs to be done on handholding side. See, there is a whole lot of SDGs to micro enterprise transition people are looking up. The Mudra, they are looking up to small. Stand Up India, women and SC/ST entrepreneurs looking up the next level. And then startup itself, right? And all these need handholding, somebody telling them that you can do it. Say somebody would have come to a level by their own, but somebody now needs to take them to the next level by just guiding. So that is what, as our chairman was mentioning, we are spreading our partnerships through NGOs and other institutions, setting up Solomon Connect Kendras. Solomon is basically a word for entrepreneurship, but we have adopted this. So these Connect Kendras basically identify the youth, right youth, connect them to right scaling agencies, help them to connect with the banks and NBFCs, and then realize their dreams. Because, the Bharat has a lot of dreams which needs to be kindled, and that is what as CKs we are trying to work. I think, but SIDBI alone cannot work. All these partners at footprints at local level are what they would take it forward.
Okay, next question, please.
Hello everyone, I am Priyanshi from ISDM. So when we talk about blended finance, there's a lot of focus on bankability of the enterprises. Now, does this bankability mean something more than risk and return? Because we are talking about the social sector here, trying to create an impact. So is there a selection criteria for these enterprises that investors or funders look for? And also, is there an exclusion criteria where certain sectors or certain types of organizations may not be eligible for this kind of funding? Thank you.
Yeah, so I'm just going to answer it shortly, and we should be. I think blended finance, the general conventional definition will be concessional capital to attract commercial capital. But you can also think of, say, catalytic TA, catalytic grant, because every sector may not be pure play financially viable, but it may be creating huge social impact. Possibly it will create no financial viability, and maybe they will not be able to return any money at all. In which case, you can always use catalytic grants to create a certain, or to try and prove a certain theory of change. And if it works, then you can attract large-scale grant capital from other, sort of social sector foundations, philanthropies, and so on and so forth. So I don't think that blended finance, by its definition, will mean that you need financial viability and commercial capital. For the purposes of what we are trying to do, which is catalyze private sector participation, that is a kind of definition we have used. But there are many organizations which use catalytic grants to try and where they create that entire, it's almost like venture capital for a developmental sort of project. And once it works, they are able to. That is also an optionality which is possible. And there are many, many such projects which sort of work. So it doesn't necessarily mean only that commercial funding has to be, used. So I'll kind of sort of, that let me leave it there and maybe take more questions from the audience. We have another 5 minutes and then we want to close. Yeah, please.
Can I, oh, sorry.
Yeah, I think we'll, yeah, sorry. Someone has a question. Yeah, sorry.
It's for me?
Yeah.
Okay. I'm Vandana from the Udayati Foundation, and we work on women's economic empowerment. So this is from a sector lens point of view. We've been hearing about a lot on climate and other interventions. But when we look at this issue of women's economic empowerment, I'd love to hear about what the thought process is. Is it from your programming, the intervention needs to be kind of embedded as part of whatever you're doing in livelihoods, jobs, et cetera, and this is kind of an incremental cut inside that? Or do you see this agenda being targeted more as a standalone facility being designed for that? So the question being, how do we draw more blended capital towards this agenda? Does it have to be a sharper lens inside your programming in whatever sectors you're engaged in, where women become beneficiaries also, which could be metrics, it could be technical assistance. So would love to hear some thoughts on that.
So we don't have as such a gender focus, and so our view, and that's just the Dell Foundation's view, is to embed it into the programming, which is already happening. And so, for example, the Skilling Impact Bond that I was talking about has a strong gender focus into it, which was, when it was brought in, then a different set of cohorts were linked, and actually a very different set of issues also came out. So for example, one of the issue came out that, the the highest cause for retention were health issues, and not having enough adequate, suitable coverage of health for women was one of the reasons, which, at some level, both the skilling agency as well as the employer needs to take care of. So that is just, the way we have embedded in our work, and, the solutions and the problems which are emerging. But, I don't think that is sufficient if we really want to change and move the needle on, gender, on any aspect of gender participation, whether it's in workforce, education, or overall financial outcomes for them. We need dedicated facilities for sure.
Great. So if I can just add that I think it's a really important question, and I think we're all trying to do the best within the mandates that we have to try and really spotlight and focus on that. Now, some of our programs have a disproportionate focus on gender. For example, the ones that were focused on microfinance were disproportionately on women. And then there was this graduation of them into for-profit companies of increasing size and scale with capacity sort of addition that happens there. And then when you look at it from a startup and for-profit enterprise perspective, you realize that there aren't so many women-led enterprises to be able to actually have a dedicated program there. So within our themes, say if it's climate or tech, it is an important criteria for us to consider whether and how we can support women entrepreneurship at different levels there. And the wider DFI community and BII also call something like this gender 2X investing, gender lens investing in that sense. So we are trying to make sure that that's quite central to us in terms of our design as we go ahead. But it also depends a bit on the market opportunity for such enterprises on the for-profit side. And like I said, on the microfinance side, of course, it's disproportionate. It's about growing that market into the graduation and the next level of aspiration there as well. Thanks.
Yeah, I'll just end it by just saying
maybe
that...
one
quick
please.
Please.
I think very similar to what Gaurav talked about, while we embed gender very deeply in all our programming, there's also that need to do that extra bit. We've done a couple of these transactions in the last 2 years where we've carved out a specific dedicated facility just for women-owned enterprises, for example, or carved grant facilities just focused on women or women financing, carved incubation facilities just focused on women. So I think that's how we are also now trying to evolve. Embedding gender in program is great, but I think you need to put money behind it, and specific budgets need to be carved out to actually, have that impact on ground.
Yeah, I think I just wanted to say that, a lot of the work and the verbiage and the vocabulary around here is large-scale capital, investors. I think one of the agendas also of the Blended Finance Collaborative, all of us here, is to create the capacity in organizations like yours, so that, because I don't think the issue is whether funds are available or not. The issue is also whether organizations are capacitated enough to be able to think about, okay, here is the women's livelihood work we are doing. Is it possible for me over and above grants to be able to attract commercial capital? And do I have the skills and the capacities and all of the other facilities available to be able to work with somebody to create a unique sort of program, which can sit under a USAID program or a FCDO program or somewhere else. That is also something that we need to do. At this point of time, the agenda of this conversation has been more around the capital side. But definitely one of the areas we do want to work is work with foundations and see how we can sort of partner with them and help them through maybe piloting some of these programs so that this doesn't become just one esoteric discussion around how can we bring commercial capital into more about working with organizations on the ground, building the capacity so that we can kind of really, because eventually you are the guys doing it on the ground. It's not the people, you know, on this table. So I think that's the other perspective. I think Neha, you had a question, yeah. Mic there. No, I think you need, you are loud, but you can also use a mic.
Thank you. So it's not a question actually, Ramraj, just a few reflections on your question that you had asked. What is it that Government of India can do and what are our asks perhaps? So 2 points on that. One is, you know, Government of India actually can look at creating a vehicle which can actually blend capital from international sources and domestic sources and across instruments.
Right.
So one of the things that I have understood from the ecosystem for now is, you know, there is a lot of bespoke kind of models and structures suiting each and every institutions, whether investors or you know, Government of India, etc., partners, to meet their own objectives. So how can we bring that together into a vehicle which can be a larger to address your you know, earlier question on the platform?
Sure.
So creating that vehicle, but at the same time also showcasing it to various partners, and you know, making it big enough for people to really be aware of and then come in and provide their capital in whatever form or manner. So that is one. And the second thing is, traditionally we have seen blended finance more you know, into the debt financing side of it. It has been in the system for a long time, and we've coined this terminology very recently. So how can we actually create a kind of template or a structure on the equity side of it? Given that there is a lot of focus through various fund of funds of Government of India and you know, the UK government as well. So how do we really catalyze that ecosystem through equity capital, but also bring in some kind of blended finance structures on that side? Thank you.
Thank you. I completely agree with you that I think converting grant funding into commercial funding in some fashion, either directly or through leverage, is not very easy today. And that's, any comments or any thoughts on I think from what Neha had to say on that particular point, in terms of really thinking about, you know, thinking about a vehicle which can, by its nature, take in equity, debt, and grants. So essentially very simple. On the liability side, take equity, debt, grants. On the asset side, give equity, debt, grants. I mean, in a way, I think that's what our wish list is.
But
please.
Theoretically, should you know, social venture fund not have been able to do that? But I think that's where maybe that clarity on where those grants can come from, because right now in a social venture fund, as I understand it, both foreign grants and CSR grants can't be invested in that, right? So without that whole grant piece becomes almost useless, because, you know, where are you getting that money from? Retail funders only, right? So I don't know if there's been any uptake. So that could be one area to maybe you know, revive an existing structure.
They can be downstream. They can be dedicated streams like you have in the Sri. You're taking in the money and then you have a lot of daughter funds.
But Ramraj, you have to solve it for the government, right?
Government. I understand.
So whenever you go and sit in front of the government, they said, tell us, what do we need to do?
Correct.
They essentially ask two questions. What is it that we need to do? And secondly, how do we do it? Right. SVL just happened to be in a great place because it was State Bank of India, run by private sector people. So it got that legitimacy or easy for governments to be able to give that money. And let's not forget, there's another vehicle that got created in SVL, which was the Swami Fund.
Absolutely.
Which has been as transformative because it unlocked 5 lakh apartments, right? So clearly, whenever, now just coming back to what Gaurav said, Finance Minister announced 4 thematic funds. The first one is likely to now come on stream. 3 are still pending. And the reason for that actually is that governments do not have the vehicles to put it out.
Got.
Now, how do we, SRI created a vehicle, and even in that, in the design, we tried to decrease the hurdles for some sectors. So the idea was that if it's enterprise or somebody willing to invest in challenging, say, left-wing insurgency area, you will have a lower hurdle. The moment you did that, it got into different sets of issues, because then it seemed to be that you're profiting the private sector more than you're doing it.
Right.
It's easier to do it in a BII setup than it is in the Government of India setup.
Right.
But you need to be, and the reason that Government of India is still not able to do it is because they do not have those trusted vehicles.
Correct.
So when you're talking to the Government of India, you will have to help create those trusted vehicles, like Neha is saying, wherein no matter what kind of capital comes in, with that flexibility of putting it out. SVL is one, but SVL cannot do everything.
Correct.
That is one. The second is my own suggestion to you, and this is where I see a bit of a danger coming in. There are 2 different streams of impact work we are talking about here. One is climate, and if I could just remove, one is social.
Right.
A lot of work that Prachi does is, for example, on the social side. Now, climate is such a big elephant that it can take any amount of capital.
Correct.
So the moment SIDBI says that we want to become the climate bank, it is because it is so much easy to get the deal flow there, and that's also where the commercial capital
will come.
Overlap is much higher. What we do not want to do is to by solving this issue, we neglect this one. Which is a big danger. So now when you're interacting with the Government of India, if you're solving the climate side of the story, it's an easier piece to solve because you have the SECIs of the world. But perhaps the pioneering work that needs to be done is on the social side.
Right.
And I was
just going to add to the point that Manav is making, is that it's not just on the vehicles to put it out, it's also the regulatory structure to take it back. Because the traditional view, again, coming from a social sector and philanthropic capital, is that this is money which is only being given out. It will not be returned. Right? So CSR capital, for example, cannot be returned. Philanthropic foreign capital coming into India cannot be returned. And, and that has not been the traditional role of social capital.
So Prachi,
right?
the thinking is that can this vehicle be one where there can be a license given the larger developmental agenda of the country for some of these rules to be broken? Like philanthropies can't take money back. CSR, if they give money, can't take it back. You cannot generate returns. There are lots of these rules which are embedded in some way, either in tax laws or in charities acts of the individual states. So is there a possibility for us to think about one vehicle where in the larger sort of goals of, at a government supported level, some flexibilities can be given which can provide legitimacy for a lot of private as well as private philanthropic and private commercial capital to kind of come in? Okay, is really, the way, sort of we are envisaging. Moving on, last question before we kind of close this conversation. I'm sure we can continue over snacks and tea. Last question, anyone? Otherwise, we can close.
Hi, Saundarya this side from Development Alternatives. Not really a question, but a food of thought if we have some time for that. Because we're talking about building scale in the blended finance space in India. We do really focus a lot on the best case scenarios wherein blended finance has worked. But I think what we really need in case we want to mainstream blended finance vehicles for India is to also focus on the failing cases. Where is it that the blending finance has not worked? Right. What did not work there? Yeah. Because that actually would become your learning ground to really mainstream the vehicles in the structure. So I think that's very important. Yeah. Just leaving that open for the audience.
No, absolutely. I do agree. Thank you for that. I think with that we will close this, what I would say was a very good sort of discussion. Lots of interesting, valuable points from all the panelists. Before I hand over to Divya to take the conversation ahead, let me just thank all the panelists for their time, for their energy, and for some of the great points that all of them have made. I think all in all, this has been a fantastic discussion. Lots of food for thought for all of us. So Divya, over to you. Please take the conversation forward.
On behalf of Asha Impact as well as the IIC, just want to say a big thank you to everyone for attending today, for the thought-provoking questions, to Vikram and Mr. Raman for the fireside chat, as well as to the panelists today. We've had some fantastic suggestions that have come up during the conversation, and I hope through the work of IBFC we can take this forward. And lastly, a big thank you to everyone who has given so much time during the course of last year to actually put out the database as well as the report. It's now available to download online. And to all my fellow authors, Swati who's here, Shivika, Divya, Ramraj, thank you so much for all your work on the report as well as the database. Thanks again. We can proceed for tea and coffee outside and continue the conversation.